The NBFC sector in India has experienced significant growth, firmly establishing itself as a pivotal player in the country's financial sector. NBFCs are highly regulated entities, primarily overseen by RBI. Previously categorized as systemically important and non-systemically important, a new classification system based on layers, that is base, middle, upper, and top, was introduced by RBI in October 2023, streamlining the processes and compliance requirements. M&A activity in the NBFC sector has been on the rise. Any significant change in ownership or control requires RBI approval. Now, depending on the transaction of nature, the approval process involves evaluating financial soundness of the acquiring group, its capability to manage the NBFC's operations, the fit and proper criteria, source of funds, and experience in the sector. The approval process can take anywhere from 3 to 6 months. The regulatory framework aims to mitigate risk associated with abrupt ownership changes and promotes the stability and reliability of the NBFCs. Understanding these regulations and navigating them is crucial for the transaction success. From a due diligence standpoint, the investors typically scrutinize the aspects such as asset composition, loan portfolio, risk management practices, potential liabilities or NPAs that could impact the valuation and future performance. From a legal diligence perspective, NBFCs generally exhibit higher structural organization, compliance standards, and governance levels compared to other sectors. From a business standpoint, NBFCs often see synergies with other BFSI sectors, which requires us to analyze these ancillary businesses to ensure that they do not flout the regulatory framework. Other key aspect is that NBFCs often operate with higher leverage ratios, relying extensively on the borrowed fund, such as commercial papers, debentures, and bank loans. Unlike banks, NBFCs typically do not accept deposit from the public, which makes their funding more volatile and dependent on the market conditions. Higher leverage can amplify both potential returns and risk for NBFCs, as they may face greater sensitivity to fluctuations in interest rate, credit quality, and market liquidity. The regulatory bodies closely monitor the NBFCs to ensure that their leverage levels are sustainable and do not pose any systemic risk to the financial sector. Overall, with favorable demographic trends, increasing financial literacy, and supportive regulatory measures, NBFCs in India are expected to continue playing a significant role in the financial ecosystem and contribute positively to the economic development. Interesting times ahead.